Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Jabil Inc. quarterly report. Jabil Inc. market capitalization of $24 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Jabil Inc. holds a significant advantage in their industry. Jabil Inc. trades at a higher price-to-earnings ratio of 35 times and a higher price-to-book ratio of 18 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. The company exhibits a very high leverage profile, with liabilities accounting for 92% of total assets. This elevated debt level warrants heightened caution, as it may limit financial flexibility and increase risk during economic stress. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has aggressively reduced its share count by more than 5% while revenue has grown, but assets and equity have declined. This suggests management may be prioritizing buybacks over reinvestment, raising questions about long-term growth prospects. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. Jabil Inc. offers a diverse range of businesses and services to various industries worldwide. At the core of its operations are engineering, manufacturing, and supply chain solutions that cater to different sectors. The company's portfolio includes electronic hardware design services for various component applications, such as analog, digital, radio frequency, power, sensor, and optical components. In addition to design services, Jabil provides systems assembly, test, direct order fulfillment, and configure-to-order services. Its product offerings include cloud data center server platforms, medical and consumer health devices, automotive assemblies, and smart controls for digital building and utilities. The company also offers a digital commerce ecosystem that connects consumers and manufacturing partners. Jabil's expertise extends to the development of solutions for emerging technologies like virtual and or augmented reality, 3D sensing, projection, and imaging. Its services also cover electrical and mechanical assemblies, as well as plastic and metal component design. With its global presence, Jabil serves a wide range of industries, including 5G, wireless and cloud, digital print and retail, industrial and semi-cap, networking and storage, automotive and transportation, connected devices, healthcare and packaging and mobility. Overall, Jabil Inc.'s comprehensive suite of businesses and services enables it to provide end-to-end solutions for its clients across various sectors. The recent surge in Jabil Inc.'s stock price can be attributed to several key factors. The company's robust financial results and optimistic outlook have been major drivers of this growth. In the first quarter of fiscal year 2026, Jabil reported stronger than expected earnings, with net revenue increasing by 18% and net income seeing a substantial rise. Jabil's strategic investments in AI data center infrastructure have also played a significant role in its stock price increase. The company has made notable investments in this area, including a $500 million investment to expand its U.S. manufacturing capacity for cloud and AI data center hardware. This move positions Jabil to capitalize on the booming hyperscale AI market. In addition to these factors, Jabil's strategic acquisitions have contributed to its growth. The acquisition of Hanley Energy Group, a data center power management company, is expected to enhance Jabil's capabilities in the rapidly expanding AI-driven data center power infrastructure market. Furthermore, positive analyst ratings and price target revisions have reflected strong confidence in the company's growth trajectory. Overall, Jabil's strong operational performance, strategic foresight, and robust financial outlook have led to significant investor confidence and a substantial increase in its stock price. The primary drivers of revenue growth or decline can be identified through a review of the key financial metrics and business developments. Revenue growth is primarily driven by an increase in net revenue, trade accounts receivable sold, and cash proceeds received. The company's regulated industry segment saw a significant growth rate of 5.8%, while the intelligent infrastructure and connected living and digital commerce segments also experienced growth rates of 5.2% and 5.5%, respectively. Additionally, the company made several strategic acquisitions that are expected to enhance its energy management and critical power solutions, global supply chain services, and contract development and manufacturing capabilities. On the other hand, revenue decline is attributed to a gain from divestiture of businesses, which resulted in a decline of $2 million. Furthermore, there was a decrease in foreign source revenue, which accounted for 80.8% of total revenue in 2024, but declined to 72.8% in 2025. This shift towards domestic revenue is expected to have a positive impact on the company's financial performance. The financial performance of a company has shown significant improvements over the past year. Net income has increased by 46% from $100 million to $146 million, indicating a substantial growth in revenue. This increase can be attributed to various factors, such as efficient cost management and effective marketing strategies. Profit margins have also seen an upward trend. The net income margin has improved from 1.43% to 1.76%, signifying that the company is generating more profits from its sales. Additionally, the operating income margin has increased from 2.81% to 3.41%, indicating better management of operational costs. The gross profit margin has also seen a slight increase from 8.7% to 8.9%. Although this growth may seem marginal, it is still an improvement in the company's ability to maintain its pricing power and manage production costs effectively. Overall, these improvements in net income and profit margins are indicative of a well-managed business that is poised for continued success. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. As evident from the data on page 8, the net cash provided by operating activities has increased from $312 in 2024 to $323 in 2025. This increase suggests that the company is becoming more efficient in managing its day-to-day operations and generating cash flow. The positive trend in operating cash flow is a significant indicator of the company's financial health. It implies that the company is capable of meeting its short-term obligations, investing in growth initiatives, and returning value to shareholders through dividends or share buybacks. Overall, the data suggests that the company is on a solid footing financially, with a strong ability to generate cash from its core operations. The company's debt level has remained relatively stable over the past year. Despite an increase in total liabilities from $17,026 million to $17,929 million, the key components of debt, such as notes payable and long-term debt, have shown minimal change. In fact, long-term debt decreased significantly from $927 million to $564 million. The interest expenses have also seen a slight decrease, dropping by $4 million from -$38 million to -$34 million. This reduction in interest expense is a positive sign for the company's financial health. Overall, while there are some minor fluctuations in total liabilities and interest expenses, no significant changes in debt levels or interest expenses are reported. Management is optimistic about the company's outlook, focusing on optimizing its portfolio through strategic divestitures of non-core assets. This move aims to streamline operations and allocate resources more efficiently. The company also has a strong financial foundation, with adequate liquidity to fund various business needs for the next 12 months and beyond. In terms of capital allocation, management anticipates net capital expenditures to be between 1.5% to 2% of net revenue in fiscal year 2026. This suggests a cautious approach to investing in growth initiatives while maintaining financial discipline. Additionally, the company plans to continue paying regular quarterly dividends, providing stability and predictability for shareholders. Furthermore, management has authorized share repurchase programs, which will allow the company to buy back its own shares and potentially increase shareholder value. Overall, these strategic decisions demonstrate a commitment to long-term sustainability and growth, while also prioritizing shareholder returns. The company's financial activities have been notable in recent times. One significant development is the payment of dividends to its shareholders. This move reflects a commitment to rewarding investors for their loyalty and trust in the company. In addition to paying dividends, the company has also engaged in share buybacks. By purchasing 1,746,604 shares, the company has demonstrated its confidence in its future prospects and its desire to return value to shareholders. Concerns have been raised regarding the accumulation of inventory, which can lead to inefficiencies and wasted resources. The data suggests that raw materials inventory has seen a significant increase of $26 million between August 31 and November 30. This buildup is a cause for concern, as it may indicate overstocking or poor supply chain management. The issue of inventory buildup is further highlighted by the mention on page 13, emphasizing the need to address this problem before it escalates into more severe consequences, such as supply chain disruptions. That concludes the financial summary for Jabil Inc. Feel free to comment below, and I will be happy to answer them when possible.